Why does the same purchase suddenly feel affordable when its price is divided into monthly payments?
A $30,000 car sounds expensive because the full cost is impossible to ignore. But $499 a month sounds manageable, even though the car costs exactly the same. A $1,200 phone feels excessive when you are forced to consider the entire price.
But $50 a month feels ordinary because it resembles all the other small bills we already accept.
The product did not become cheaper. Only the number placed in front of your attention became smaller.
To see how the trap works in real life, consider someone named Alex. Alex is 29, works in company operations, and earns $72,000 each year. After taxes, insurance, pension contributions, and deductions, about $4,300 reaches his account monthly.
That is not a low income, and on paper, it should provide a reasonably comfortable life.
Before the month properly begins, $1,600 immediately disappears into rent.
Utilities, internet, and his phone plan quietly remove another $220.
After taxes, insurance, pension contributions, and deductions, about $4,300 reaches his account monthly.
Groceries and eating out together consume roughly $700 every month.
Insurance, transportation, subscriptions, and ordinary personal spending take another $650.
And that remaining space is exactly where monthly payments begin quietly taking control. When his old car begins needing repairs, Alex decides to visit a dealership.
The car costs $32,000, and the full number immediately feels uncomfortable.
But the salesperson quickly moves attention away from the uncomfortable $32,000 total.
Instead, the conversation shifts toward what Alex believes he can manage each month.
The question becomes, how much would you feel comfortable paying every month?
Alex chooses around $500 because that amount appears to fit his budget. After changing the deposit, interest, and loan length, the payment becomes $515. $515 feels possible, so Alex signs the agreement and takes the keys. The mistake is not automatically buying a car, because reliable transportation may be necessary.
The mistake is evaluating the car as a $515 decision instead of a $32,000 decision.
Repeated for 6 years, that monthly payment becomes $37,080. Add insurance, fuel, servicing, repairs, registration, parking, and depreciation. Once those costs are counted, the car's financial impact can easily exceed $55,000. But Alex never experienced it as $55,000. Mentally, it remained a $515 decision.
A few months later, the same logic returns through a phone, furniture, and a financed holiday.
Streaming, cloud storage, and a fitness app add several more payments that seem almost insignificant.
None feels destructive alone, but together, they quietly claim a large share of future income.
The brain naturally focuses on immediate affordability while pushing the complete long-term cost into the background.
Small monthly numbers reduce the psychological discomfort of spending without reducing the actual price.
The pleasure arrives immediately, while the cost is fragmented across months or even years.
When everyone finances lifestyle upgrades, recurring payments begin to feel completely normal. The question changes from whether the purchase is affordable to whether this month can absorb the payment. Those questions are not equivalent because one examines the purchase while the other examines only 1 month. Together, Alex's new commitments consume $826 every single month. Across 1 year, those manageable payments become $9,912.
Across 5 years, they approach $50,000 before extra interest, replacements, or new borrowing.
The usual danger is not sudden bankruptcy. It is slow, almost invisible financial stagnation. Savings remain small, investing is postponed, and unexpected expenses return directly to the credit card.
Changing jobs becomes harder because every future paycheck already has obligations attached to it. A raise can fund a better car, larger home, and more subscriptions, while financial flexibility remains unchanged.
Financially intelligent people may still finance purchases, but they calculate the complete obligation first. Financially intelligent people may still finance purchases, but they calculate the complete obligation first.
A $500 payment also reduces savings, investing, career freedom, and the ability to absorb emergencies. Monthly payments can make almost anything look affordable, but the full obligation often makes the decision look very different. Is the benefit worth the lost flexibility?